There we go.
Hi, everyone. Hi, Sean.
Can't see if there's a lot of people out there or not. So let's assume it's absolutely packed. Every seat is full. Is that right? I think so. There we go.
And people are awake and paying attention and stuff at this hour. So yeah. So
late night for you, Marta, last night? 5, 6 in the morning?
5.
Okay.
Yeah.
Typical Slush event. Very cool. So we're here to talk about the past, the present, and the future of the venture capital world. What's been taking place? What do we think about at night? What keeps us up at night when we can't sleep, besides the slush parties? And debate that. And that's what we're going to do over the next 15 minutes or so. But to begin with, Marta, why don't you give a little bit about your background and North Zone?
Sure. So I work for a fund called North Zone. We're the largest Nordic technology investor. We've been around for about 18 years and have done some 100+ investments. And there I'm part of the early stage investment team. I guess I'm here also because this is my second fund. Before that I was at DN Capital in London. So I've seen the different models and the different markets between Scandinavia and London. That's, I guess, my perspective.
And North Zone's been quite active in the Nordic territories in general. Finland as well?
Yeah, somewhat. We have a couple of investments in Finland. With our new fund, which was launched recently, we're definitely making a bigger push into Finland.
Fantastic. Excellent. And I am with ProFounders Capital. So we are a London-based early stage internet mobile e-commerce kind of tech investor. I suppose what's unique about us, and part of the reason we set it up, was to try to bring the US West Coast model of founders supporting founders, which is what we think's made a real difference to that environment, to Europe. So we only raise money from successful founders, and that's the idea behind the fund. And we've made 3 investments in Finland over the last 4 years. So we're investors in Amplifier, which was bought by Unity. We're investors in MovesApp, which was bought by Facebook. And we're happy to be investors just recently in Small Giant Games. So hopefully the next super big Finnish gaming company.
Yes.
I want to start by giving you guys some perspective on venture capital. So kind of the origins of it, what it is that VCs claim they do, and then we'll debate about whether or not they actually deliver on that. And if we do have time at the end, we'd love your experiences on VCs and whether they've lived up to the expectations of what they've promised. But to put things into perspective, the VC industry is quite young. It came out of California in the 1970s. And it was a convergence of 2 things. It was a convergence of disruption in technology space, which was the emergence of the semiconductor world, and the confluence of capital with that, and the ability to fund companies, to provide them the ability to grow more rapidly in advance of revenues. And that's how it really began. And in the 1970s, 1980s, and up till about 1995, it was around semiconductors, then it was around the desktop computing environment. And all of that was really centered in Silicon Valley, which had this legacy history that allowed it to really push forward. What you started seeing around 1995 or so was the emergence of a new paradigm, which is the internet. And we'll get to the mobile paradigm, which is what is taking place right now. But it really became the internet paradigm. And we saw that the internet was a more diversified world, right? There was CERN, there were groups in London and Cambridge, and we saw technology starting to be developed in all these environments. Unfortunately, the capital environments kind of lagged behind that. And it wasn't until 2000, 2005 or so that there started being a solid ecosystem of capital to support emerging European businesses. And then most recently, the newest shift, as we talk about, is the mobile shift. And broadly on top of that, you're layering the lean startup. And what I mean by that is it's much cheaper to build companies now than it was 10 years ago because of open source software, cloud computing, outsourced tech development. It's really much cheaper. And so what was originally a worry for Europe, not enough capital, is lessened because there's actually more capital kind of available.
Well, there's that, and then there's also scale to the whole ecosystem, which is what the Valley still, why the Valley still dominates the space. Not for much longer, I think. But there is a certain critical mass of the different stakeholders in the ecosystem that enables it to be a liquid, healthy, self-sustained ecosystem, right?
Yep. Definitely, and I think up until probably 2010, Europe was really lacking in that space, and now we do see. I'm an American, but I choose to live in London and be part of this ecosystem because I think it really is emerging as a vibrant place to build companies. But the way I thought about it was 70s was West Coast infrastructure. the 90s, 2000s, you saw technology developing worldwide, but funding is still quite local. You want to be close to the companies that you invest in. Now we're in the 2010 plus environment, and we see more shift. Really things taking place quite rapidly in our industry. 3-4 years ago, we saw the rise of the micro VC, so smaller, more nimble venture capital funds that took advantage of all the things that we're speaking about. And before we go any further to talk about the future of VC, let's talk about what it is VCs claim, or how VC works, right? So most simply, when we invest in a company, we get equity ownership in that company. In return, we also get, you get us, for better or worse, and the cash. And that's the most simple kind of mechanism for it. There's all kinds of other intricacies and things that flow from that, but that is the core of what the VC model is. Now, VCs, if you've ever spoken to them, also claim it's not just the money. We're differentiated as a fund. This is what we provide to you. So what I thought we would do, Marta, is we'll take those one at a time and debate what's taking place in Europe and worldwide from a funding perspective. And let's talk about whether or not there's actually a role for investors, for professional venture capital investors going forward. Because we are seeing lots of new venture capital models emerging. And what we'll do is, this is going to be more of an intellectual debate, and I'm going to take as a VC, the pessimist kind of route. So I'm going to say my premise is that we're out of jobs in 5 years. The venture capital model as we see it will not exist. Marta, you can play the supportive, nurturing, positive investor, and what we can provide. So number one is, and I had to look this up on Google Translate, but number one is cash, right? Mula, capital, raha in Finnish, I think if that's the correct word for what it is. So it's great. So VCs, yes, we provide cash. Guess what? There are many places you can get cash now. Have you guys heard of AngelList? Who's heard of AngelList as a platform? No one or everyone, I can't tell. AngelList, take a look. What about Kickstarter or Indiegogo or any of these other platforms? So cash is king for the companies, but we don't have a monopoly on it anymore. Yep. Counterpoint?
Yep. Neat. So cash is king, and we believe that at a certain level, the online services such as crowdfunding campaigns, crowdfunding websites, and even the AngelLists of this world can provide the initial capital. So they're kind of displacing the local angels, which then would have been the natural kind of feeders to the local VCs. So that we see as a disruption. But when you reach a certain scale, when it's like you're raising, I don't know, north of a couple of $1 million, you really need to have a kind of a clean cap table. And having that through thousands of owners is not really something that potential acquirers or investors are that they think is interesting. Yep. That's one.
But will that change? Because I think about in London, there's these platforms called Seedrs and Crowdcube, and a year ago people were raising £100,000 on them. And I look now, and there's people raising kind of £1 to £2 million on these platforms.
So what we're seeing is that, like, through Crowdcube is a great example, because what we're seeing is that Crowdcube is starting to cooperate with VCs. So a number of companies that I've seen have raised like maybe a 3 million round, of which half was Crowdcube and half was an institutional investor. And we think that's super healthy, because then you get market buy-in. Like, we see that especially for hardware products, like wearables and things, getting the Kickstarter campaigns of this world to prove that you have traction is a great data point for then scaling the business, for making something substantial out of it.
Yeah, I guess Pebble Watch, right, is the big example of that. The Pebble Watch,
yes.
which raised a lot of Kickstarter money awareness and then raised VC on top of that.
So I think it's an interesting marketing model, so to speak.
Yeah. Cool. So number two, so VCs, what else do we do, right? If we look at our day and how we fill it. So deal selection as well, right? There are a lot of deals. If you look at Kickstarter or any of these crowdfunding platforms, there are tens of thousands of opportunities. So, choosing the right investments on behalf of the people that give us the money is an important role of VCs. If I brainstorm to the future, I would say, frankly, it's only about the 1 in 20 that we get right anyway, because most of the companies we invest in don't work out. So, heck, why can't someone sitting at home have as good of a shot at it?
So yeah, so the failure rate of our companies is quite high. I think it's somewhere north of like 60%. That's kind of what goes with the model. It's in a sense, it's a hits-driven business, and you have to look into the future, right? So and you have to look into a future which most of the time will unlikely happen because a whole bunch of things need to come together so as for this future to actually take place. But when it comes to deal selection, I do believe that there is substantial value in seeing a market and being able to understand what the underlying value drivers are and where, what an ecosystem looks like and where you're able to penetrate it. And that coupled with a network that you gain through, having been in tons of other companies and having industry insight is something that I think is more difficult to scale for a platform like whatever, AngelList.
I suppose we could have wisdom of the crowds in the future, which you see if a lot of people are in favor of it, that could happen. But no, I understand. I mean, I like to think I have some level of knowledge about where things are headed. Not as much as the entrepreneurs, but just enough to potentially be dangerous.
Well, actually, I'd like to raise a point here, and that's a great point. I think now more than ever, our skill set is tested. What is it that we actually add to the table, right? And I think you're gonna.
We'll come to that. Very good point. So, number 3, and by the way, I pulled these all off kind of forums and blogs from entrepreneurs about what VCs provide. Number 3, the network, right? So the connections that we have. So, so is that valuable? I mean, if we look in the future. There's LinkedIn now. There's a lot of platforms where you can connect with the people you want to connect with. Is a board member who claims to be well connected valuable?
I think a board member who is well connected can be super valuable. But that's frankly the most successful entrepreneurs that we know are so resourceful that they don't need us from that perspective. So we're the guys that they come to when there's a strategic issue where you're kind of in a deadlock, and that's really the only time we should speak.
Fair enough. Good point. Now, shared portfolio learnings, that's another thing that came out quite frequently, was the network of companies. Northzone must have, I'm guessing, like 70 companies, 100. We've got 25. Do you bring them together? Is there value in that
well, I guess our portfolio is the best to ask. I don't know if there's any of our portfolio here right now. But we do see some learnings in terms of, you have operational issues that cut across all industries. Like, when it comes to launching a product, what are the pitfalls? What can you expect? What does each valley of death post-investment entail? And that's something that we think you can carry over from investment to investment and help the companies not only survive it, but push through it quickly.
Got it. So now if we look at VCs and innovation among venture capital funds, I think the two most extreme, and I'd love your thoughts on each of these models, and I'm going to use real life firms. So I'm going to actually talk about real people. Please don't tweet or quote me on it or whatever it might be. But at one extreme, there's groups like 500 startups, which actually now have about 950 startup investments. So they got to rebrand at some point to 5,000 startups, I suppose. But they're very much small ticket sizes, lots of deal flow.
Low touch.
Low touch, exactly. So they basically say, yes, the smart entrepreneurs are going to figure it out. VCs don't provide that much anyway. We're a little bit of cash to help them out along the way. And another extreme would be a relatively new fund, but everyone's heard of Andreessen Horowitz out in the Valley. And they have close to 200 employees now, I've heard. And they basically say, you come to us, you get Mark Andreessen and Ben Horowitz, but you also get a finance team, an HR team, you've got market research people, and they really try to be the full service provider to startups. I mean, do you guys at Northzone debate that and think about what's the model for you guys in the future?
So obviously with the rise of the Andreessen Horowitzes of this world, we have come to reconsider our strategy and think, should we deploy similar resources? And frankly, we don't think that actually scales. We think that companies do want to have these things in-house, and we think that benefiting from a dynamic teams, that are truly the best in class, is more beneficial than having them in-house. So they become stale and whatnot. So that's one observation. On the 500 startups, super low touch, we call it spray and pray as well. That's a strategy that can work sometimes. We feel as though they're actually complementary because they take the losses of the 70-80% loss rates And then that increases the chances of our companies actually succeeding because they've come through this like mess, basically. So if anything, the most important thing for us is to continue to be super data-driven, very quick to make decisions, to decide to support a company or not based on certain fundamental data.
Cool. And so if you were now forecasting 5 years ahead for North Zone, what does North Zone look like? Is it kind of as is? Is it more 500 startups? Is it more Andreessen Horowitz?
Do I have to choose between the two?
Whatever you want.
So North Zone today, North Zone started off as a Nordic fund, and 2 years ago we opened our London office. A year ago we opened our New York office. So to us it's about being able to provide value to Nordic firms primarily around the world. And we don't think that on the operational front that makes sense. We believe that Nordic companies have a certain Nordic DNA that we speak of sometimes, which is dedication towards product, which of course stipulates a lean company approach, strong focus on design, and then super strong focus on being born global. And that's something that, that's why we see, that's why I think it was TechCrunch that called, or VentureBeat or someone, that called Nordics the most prolific billion-dollar club in the world. And I think that's just the beginning of it.
They're very bullish. Excellent. So we have 32 seconds left. So what I did was I went to Quora, if you guys know Quora, and I typed in, what do VCs actually do? And I looked at the most upvoted answer on all of Quora. So let me read from this. And this is from Jason Lemkin, Managing Director at Storm Ventures. He was the #1 upvoted answer. And said, my learnings, but the most valuable ones to me, were #1, catharsis. Beyond your co-founders, few others may be along for the whole ride. Your VCs are. They're there through the ups and the downs. And they're invested personally with you. And that's very emotionally helpful. #2, perspective. Anyone can be a critic. What's much harder to point out is whether what you're doing feels right or could be right. And they have good global perspective in making that happen. #3, a few good men or women. So VCs can bring you 1 to 2 great hires per year. And #4, someone to look out for you. And it says the great VCs, especially the early stage ones, do this. They're highly invested in you. They're thinking about what will help you do even better, be it a COO, secondary liquidity, a vacation. The good ones are thinking about the entrepreneur and their personal success, because without the entrepreneur, we're not successful.
Yeah, and to finish off, I think we can both agree after this session that we invest in teams, right? And a lot of the time, the first ventures of founders are not successful. And if we see the value in this person who has fought through the battle, that's not something that a crowdfunding campaign can replace.
Definitely.
So it's about investing in teams.
Great. Thank you very much, Slush.